I'm not going to talk much about wheat, but I will show this chart. Again, nearby futures for the winter wheat contracts broke below $4, new lows for the decade. So not a whole lot of good things to say about wheat. But it shows how the U.S. No longer dominates the export market and what that loss of market share can mean. 40 years ago, the U.S. controlled almost half of the world trade in wheat. That's down to just 15%. The former Soviet Union, which wasn't exporting any wheat at all, really, 40 years ago, was importing wheat from the U.S. from time to time, now is the world's leading exporter. But you'll notice that none of these regions has a real dominant market share. And that's one reason why prices are struggling. When you have a fragmented, competitive market, producers compete on price, and the low price usually wins. Now, the feed grain market, including corn, has done much the same thing. We used to have a 2/3 market share back in 1977. That's down to 1/3 now. Growers in not only the former Soviet Union, but also in Brazil, have really started adding acreage. And this chart is starting to look like that wheat chart. And if we get that fragmented market in corn, it's going to make prices a lot harder to rally longer term. Now, the world has changed in soybeans too. We used to have an 85% market share 40 years ago, but of course, South American production has expanded greatly since. We just have a 38% share currently, and Brazil is actually the world's leading export, and that's nothing new. That's been the case for several years now. I also spent a lot of time talking to growers about the dollar. Now, when we talk about the dollar, there are really $2. The first is this bottom or red line. That's the trade-weighted index that's traded in New York. And that's composed of only 6 major currencies. And that includes the British pound, euro, yen, Swiss franc, and the Canadian and Australian dollars. The second index is a broader index, includes 28 of our largest trading partners. You'll notice how the U.S. index traded in New York has been mostly flat, but that larger index has been slowly rising. This is important because it includes a lot of emerging markets. These are not only our customers, who can be hurt by a stronger dollar, but also our competitors, and they can many times be helped by a stronger dollar. And the corn market has really had a varied relationship with the dollar, and I think that's important to point out. Now, a lot of producers believe that a strong dollar hurts U.S. grain exports, but actually, as this chart shows, that correlation goes up and down. And the stronger dollar does affect prices because the grain prices around the world adjust for different currencies. If the dollar is up, our prices tend to be lower. If the euro is up, the prices in Paris may be lower. The same thing with the Australian dollar and the other major currencies. The thing about the dollar is some days buying in the dollar means traders are bearish. Some days it means they're bullish and vice versa. So you have to look beyond the headlines, try to figure out what's really going on with these currencies. The dollar is important. It tends to follow interest rates. Now, this year's farm shows took place ahead of the September meeting of the Federal Reserve. Of course, all the talk was about the potential for rising interest rates. And it looks like interest rates are going higher. That's important because, as this chart shows, the dollar, that's the green line, does follow interest rates. Now, we aren't talking about increases like we had back in the 1970s and 80s when Paul Volcker raised interest rates and helped trigger the farm crisis. We're talking about very minor increases. But in today's low interest rates environment, just a small move can have a big impact because many countries have negative interest rates, including Japan, Europe, and even the Swiss. So if you want a safe investment, you don't have a lot of choices these days, and that's why the dollar has been gaining some strength. The other reason we look at interest rates is because they can be a predictor of what may happen in the overall economy. This is the Treasury yield curve. As you can see, it shows the short-term rates on the left, longer-term rates on the right. Farmers tend to borrow their operating money on the left at those lower rates. Land rates tend to be just a little bit higher. But over the past couple of years, they've come down. There used to be a 3% premium. Now it's down to a 1.5% to 2%. And as that yield curve flattens, that's important, because a flat yield curve has predicted every U.S. recession since 1950, but has only given a false signal once. So if we start to see short-term rates rise above the longer-term rates, that's a real danger signal. Now, it doesn't mean a recession is going to happen right away. It can take a long time for this to play out, but it is a warning sign that growth may be at risk. The dollar is also important because it can influence money flow into in and out of our markets. This is the crude oil chart, and you can see that the big funds, that's that blue line, they were bearish earlier in the year. That's one reason why we saw the big break in prices. But they started betting on crude oil again. In fact, they bought $8 billion worth of crude oil futures contracts in just a couple weeks. When they sold those recently, they sold off 2 billion of those in just a week, and that helped push prices lower. That money flow also influences agricultural prices, of course. This chart shows the total number of crop and livestock futures contracts. The big speculators are either long or short. Right now, they have a small bearish bet on. During the springtime, they were very bearish, headed into the March 31st reports. Then they started buying again, and that's one reason that triggered our rally. They started buying because of the rally in crude oil, which triggered short covering, which can also drive prices higher. It's no secret that big speculators influence prices. This chart shows what happens in corn. The green line is the position held by the big speculators. The red line is the nearby corn futures. You can see prices go up and down depending on that money flow. The same holds true in soybeans, where the hedge funds sometimes start buying before prices start to rally. So that's why we watch that money flow so carefully. Now, currencies also play a big role in what happens to our competitors. This is Dilma Rousseff, the former president of Brazil, who was just removed from office after a lengthy impeachment process that really battered the euro. Of course, Brazil has had a recession for a couple years now. It looks like that's going to continue with low growth or negative growth in 2017. And that's caused the Brazilian currency, the real, to weaken considerably. Now, when I was down in Brazil a few years ago, the real was trading 2 for 1 against the dollar. During the January, the deepest part of the crisis, it moved to 4 to 1. So Brazilian consumers lost 50% of their purchasing power. Farmers, on the other hand, it was a boon for them. As the real weakens, their prices are set off the Board of Trade in Chicago in dollars, so they get more reals for each of their dollar they sell for. Coupled with the rally we saw, that drove 2017 soybean prices, that's for the crop the growers are starting to plant now, basically as high as they've ever gotten. Markets backed off a little bit as soybean prices retreated and the real strengthened a little bit. Prices still pretty attractive. Now the question is, the same thing's happening in corn. We have record corn prices in Brazil. They had a short second crop. And is that going to wind up shifting acreage, not only in Brazil, but also in Argentina? This is their new president celebrating his victory. Now, Brazilian or Argentine growers were prohibited from owning dollars for many years. Back in the early aughts, they defaulted. on their international debt, became a real pariah for the financial markets around the world. That took years to play out. In fact, those lawsuits are still kind of grinding on in some courts. All the while, the Argentine peso, that was the only currency, if you were Brazilian, you could own, kept getting weaker and weaker. Now, when Marici took office, he let the peso float, said people could own dollars again. The currency devalued rapidly back to where the market thought it should be. Started to stabilize, but again, this has really benefited Argentine farmers. They're going to be getting a lot more pesos for their crops. When the currency was devalued back in 2002, 2003, Argentine growers also benefited. They were able to pay off their loans not in dollars, but in pesos that were rapidly becoming worthless. Now, during those years of high inflation caused by the dollar ban, farmers in Argentina had only one hedge against inflation. That was hoarding their soybeans. They did that with their 2014 crop, and that's one reason why we had record soybean meal exports. Argentina is the largest exporter of soybean products. Now, the exports have backed off a little bit, but they're still very strong. Argentina had a bad crop this year. Things were going well until harvest started to rain. Spoiled a lot of the crop, and that opened a window for our export sales, both of soybeans and products. Crush margins for plants, also fairly attractive, and that's keeping the crush fairly strong. And in fact, it looks like world soybean stocks are going to be tightening over the next few years, and that again should help support soybean prices. The reason is strong demand. And the reason for that strong demand is China. China just keeps on buying more and more soybeans. Their share of the world market is about 2/3, and it's edging higher, and looks like that growth will continue. Now, there is a big debate going on. The import growth has been fueled by the rising Chinese economy. There's a strong correlation between GDP growth and soybean imports long term. But the blue line on this chart shows how their growth has been slowing. Now, this was a conscious decision by a new government that was installed a few years ago, trying to correct some of the excesses that have worked into the Chinese economy, corruption, pollution, and debt. Trouble is, they probably slowed down things too much, and that started to cause some worries about whether or not their growth would be strong enough to keep their imports of soybeans growing. Now, USDA typically underestimates the soybean demand from China. Looks like they did that for the 2015 crop. This year, they're calling for only a small increase in Chinese imports of soybeans overall. And if that happens, of course, it could be negative for prices. But if their track record holds, China could wind up buying more soybeans than anticipated, tightening supplies, and again, helping to support prices. Now, we also watch the Chinese currency. It can tell us a lot about what's happening in that country. Even though U.S. politicians have regularly beaten up the Chinese government for devaluing its currency, it was actually strengthening on this chart when the currency is going down. That means the currency is getting stronger. It was strengthening until they started slowing their economy in 2014. Then the government, People's Bank of China, really took a meat axe to slow growth and devalued the currency a year ago by 2%, devalued another 1% after the Lunar New Year celebration this February. Really unnerved the market and raised questions about the government's ability to handle this slowing growth. 1 year ago, everyone was talking about the Chinese stock market. It was melting down. That's one reason why the People's Bank did that 2% devaluation. Market stabilized a little bit, and then the weak growth fears came back in February around the Lunar New Year. Now, since then, the market has just been in a very sluggish sort of consolidation phase. Now, the Chinese stock market is not a big one, and we never really paid much attention to it at all before last year's crisis. But there is a strong correlation at times between soybeans and stock prices in China. That's what this chart shows. That red line shows right now we're starting to see that correlation strengthen again. Back during the financial crises a year ago and also in February, the correlation was almost 1-to-1. As Chinese stocks went down, so did soybeans. Now, the smaller Argentine crop and strong demand from China helped boost soybean exports last year much more than expected. We got off to a pretty decent start, and then things really took off this summer at a time when we're normally not exporting much, when that window opened due to the smaller Argentine crop. And sales have stayed fairly strong, even at a time when we're still waiting for new crop beans to hit the pipeline. Have a fairly strong book of unshipped sales that should support prices. Not a record, however, but certainly stronger than a year ago when Brazil was still shipping out a lot of its big crop, and so that slowed down the start of our export season. The reason why people are buying from us now is very simple. Our beans are the cheapest on the world market. The price out of the Gulf is that blue line. The green line is Brazil. And it looks like we'll have the cheapest prices on the world market for several months at least. And that should help support demand. Now, USDA is calling for that stocks-to-use ratio to be much higher for the 2016 crop. I think that big bar there is going to come down when all is said and done and be fairly tight again for 2017. That's why I'm fairly optimistic about the potential for soybean prices to rally. Now, China also a big factor in the corn market, unfortunately negatively. This big pile of corn is not in Iowa, South Dakota. It's in China, where they have maybe a year's supply of corn on hand. Nobody's quite sure. Some of it dating back 5-6 years. The government has been holding a lot of auctions trying to get rid of it, finding very little interest. The reason why Chinese corn stocks built so high was because the government was encouraging farmers to plant corn. For the 2014 crop, farmers received a support price of about $9.50 a bushel. The government started backing off that for 2015 down to about $7 for this year's crop, all the way down to $5.50. So they're trying to discourage production, but it's going to take time to work off those big stocks. Now, there's talk that China will perhaps fallow 20%. And they've started, instead of having a high support price, just giving farmers payments. If all that sounds familiar, kind of the same farm program we tried 30 years ago. So it didn't work for us, probably won't work for them. I expect them to announce a PIC certificate program any day now. China started importing corn from us back in 2012. And then they used the GMO issue as their stocks began to bulge to really slow down and pretty much squelch any imports from the United States. At the same time, they signed a long-term trade deal with Ukraine, giving Ukraine loans in return for the promise to buy grain. Trouble is, when I talk to Ukrainian farmers at the Farm Progress Show, the Chinese aren't buying very much corn. Last year, just 120 million bushels. That's really a drop in the bucket. The Ukrainian crop is very big, starting to come on the world market, and that's going to probably depress prices moving forward. Now, the corn exports started out very slowly last year, got off to a slow start. Again, Brazil had a huge crop, so there was plenty of corn on the world market, but when the second crop in Brazil this summer turned out much smaller than anticipated due to hot, dry conditions. Our exports really took off, and they've stayed strong at the start of the marketing year. We're basically holding a clearance sale, getting rid of as much old crop inventory as we can. Now, the U.S. had the lowest prices on the world market for much of the summer. That's starting to change now. The price in Ukraine will soon be below ours, and they're going to be controlling markets into the Mediterranean and South Asia as well. Again, making it hard for our exports to really get to as strong a level as we need to work off our big stocks. There's a good book of unshipped sales that we have, but there's not a real strong correlation between this number and what we finally wind up selling during the marketing year. And overall, as this chart shows, goes all the way back to 1970, our exports fluctuate from year to year depending on how much of a supply we have. But that market is not growing, unlike the soybean chart, which is a steadily rising chart. Feed usage bouncing back from the low levels that we fell to after the 2012 drought and the long-term drought on the plains that cut the cattle herd. But we're below levels from 10 to 15 years ago. A lot more DDGS working in feed rations, a lot of cheap wheat. Growers around the world and the U.S. Really have gotten into feeding the least cost ration. Industrial uses for corn growing slowly. This is primarily ethanol. The big days when we were building plants right and left, those days are over. Now we're basically using ethanol so we can blend 10% to meet the pollution requirements. Cheap gasoline is increasing the demand for ethanol. So that has supported prices. Overall, ethanol tends to follow crude oil. It's been holding up a little better than the crude oil market, at least until recently. The margins are pretty decent, so plants have been making money here over the summer and into the early fall thanks to strong demand. And in fact, production of ethanol hit an all-time record several times this summer. However, one of the issues we're dealing with is that plants have become more efficient. We've set record efficiency levels over the spring and early summer. If that trend continues, it means we don't need as much corn to make the fuel that's needed. So overall, the growth in corn demand fairly slow and certainly not as optimistic as we've seen in soybeans. And that's going to keep the stocks-to-use ratio at basically about as high as it's been over the last 10 or 15 years. Again, that's a harbinger of lower prices longer term. So next, I'll talk about the storage prospects for your 2016 crops.